Good morning and welcome to Stock Market Today. It's Monday, April 6th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas. They hit your inbox every trading day before the market open. So U.S. equities ended lower in Friday's trading, though off the worst levels of the day. Consumer staples was the only sector to finish higher on the day. Utilities led to the downside. Treasuries were mixed with the curve flattening. The dollar rallied against the major crosses. Gold finished up 0.5%. WTI crude continued to rally, up nearly 12% on the day to close out the week. And as we get to the desk this morning, U.S. S&P futures are up about 3.7% after coming under pressure last week. Some of the statistics around COVID-19 took on a more positive tone over the weekend. Asian markets are higher overnight, with Japan and Australia leading. China was closed for a holiday. European markets are also seeing big gains. Treasuries are weaker across the curve. The dollar is stronger against the yen and the euro. Gold is up 1.3%, and WTI crude is giving back, call it 2.7% after a nearly 30% rally last week. So, in the absence of company-specific news ahead of earnings, which kick off next week, really, the ebbs and flows of the market are likely to continue to center around COVID-19 data. We do expect volatility to remain elevated in both directions. And as we take a look at the structure of the S&P 500 here, you kind of consolidated over the past 3 days above the 2450 level. I'm willing to kind of give this 2450 level a little bit of credence. 2350 to the downside does remain important initial support, and then 2000 to 2100 below that. Now, resistance still at that 2650 level. Remember, that's the 38.2% retracement of the entire move down. And we are trying to fill the gap as futures do trade higher here this morning, trying to fill this gap that opened on Wednesday morning. The RSI holds bearish ranges. Chaikin money flow is bullish, but fading once again. So the indicators are mixed to a slightly bearish tilt. I think what we have here is a really wide consolidation range as the market tries to carve out a base and determine, the future path. Volatility likely to persist inside this range. Hard to get excited below 2650. And below 2300 is really kind of the make or break line in the sand as far as I'm concerned for the S&P 500 right now. So for the week, stocks trade in a wide range as two-way volatility persists. Treasuries continue to consolidate after a strong move to the upside. That would be a strong move to the downside for yields. Rebounding crude oil, but the trend remains bearish. This is our market in a minute. It's what I'm writing about in our note today. Dollar rallies for moving average support. And as I said, futures do point to a higher open here on a Monday morning. And as we take a look at the major indices from a power bar perspective, I guess you could call it a slight improvement over the past week, but still very much buried to the downside. The Dow, 0 bulls to 7 bears after losing 1.5% on Friday. S&P 500 down 1.4%, 9 bulls to 145 bears there. The NASDAQ, very slight outperformer, 8 to 25 bulls to bears. There are your small caps continuing to underperform as that ratio remains very much bearish, 56 bulls to 484 bears. Bonds uptick, sending yields lower. And according to the Chaikin Power Bar, small cap stocks and large cap stocks remain strongly bearish. We've been talking about that. We've been showing you these ratios for the past few weeks, and they really are buried to the downside or the bearish side of the equation. So just something to keep in mind. We are likely to see rallies that seemingly come out of nowhere, as Mark Chaikin wrote about in his note over the weekend for our clients. Bear market rallies are real. We need to be mindful of them. We've laid out the levels for you in the S&P 500 that are important for us to watch. Now, our stock of the day today, this one not auto-generated. This is actually a stock I'm featuring in my note to clients today. It's Trex Company. TREX is the ticker symbol there. It has a very bearish Chaikin power gauge rating due to very bearish financials as well as very bearish expert activity. Now, earnings and technicals are bullish, but when we take the 20 factors, 5 in each of these 4 categories, we kick out that very bearish rating for a stock that's in a weak trend, below the declining long-term trend line, and a weak industry group, right? Most industry groups are weak. Building products not immune to that. So Trex had a nice rally with the market and then began to fade to remain below the trend line. The stock is overbought with bearish money flow. And what's interesting to me is we're starting to see the intensity of underperformance pick up again. Trex kind of name that I think that with the, if you look at our work, S&P and the major ETFs are overbought. You want to look for overbought stocks to potentially take money off the table if you're involved. If you do trade to the bearish side, these could potentially be compelling names if they fit your framework. I think if you get kind of rallies in Trex in the near term, they could be opportunities to open bearish to the, whether you do that via options or outright, depending on how you personally manage both sides of your investment portfolio, both the bearish side and the bullish side. The stock is certainly not bullish. I think it presents more bearish opportunities for those who are interested in taking advantage of them. You might want to add Trex to a bearish watch list here today. Taking a look at our sector tracker now, moving to the major sectors over the last 5 days. Big rally in oil helps the energy complex, pushes it to the top of the list. I do still feel that that's counter trend in nature. Staples, a defensive group, continues to hold up well, as does healthcare. Comms, tech, materials, and industrials are middle of the road. We'd love to see tech outperform if you're bullish. Discretionary real estate, financials, and utilities towards the bottom of the list. And it's kind of interesting to me that our defensive groups are now towards the bottom of the list. I'm highlighting the utilities in my note today to basically say, they've really started to underperform again, even as the market was weak. So if you're kind of looking, going through a checklist, through a basing process, I think one of the items that needs to be on that checklist is the relative performance of utilities. And last week was a step in the right direction as utilities underperformed, even as the market was weak. So that's something that we are going to continue to monitor closely, and we will continue to focus on a lot of the other data points that we look for as a potential base process plays out. Now, our industry in focus today is healthcare services, which has kind of been an inline to slight outperformer, leading the S&P 500 over the past 6 months by about 11 basis points. However, that power bar ratio, like most areas, is very weak, 0 bulls to 9 bears. It's currently ranked number 18 of 21 subsectors, and it's moved down 14 slots over the past week. So the names that we want to avoid in this group: Health, Equity, HQY, Hanger, HNGR, and Guardant Health, GH, very bearish, and bearish, respectively. And if we take a look at the chart here, you can see that it's hard to get overly excited about this group. And there are pockets of healthcare that we like, and we do continue to think that, on a relative basis anyway, healthcare acts okay. But you do need to drill down to the specific areas. And if we look at services, right, neutral plus rating for a weak trend, overbought with bullish money flow, but this really has caught my attention here, right? Big move back down to the downside for relative performance. So we're going to keep the relative in mind. Remember what we were saying, as we are working through or potentially working through a base building process, you want to identify the areas of the market that have held up the best, because those are your likely, I stress likely, leaders should the base building process play out and eventually resolve itself to the upside. Right? Not guaranteed now, still expect a lot of two-way volatility, but we can see that healthcare services is one of the groups that is under pressure. So just something to keep in mind. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, or gainers and losers for Friday rather. L Brands was up 11.72% as they've slowly started to open some Bed Bath & Beyond stores, trying to make the case that those stores are essential. Stock is still very bearish, rallied 11.72% on Friday. Market Access, MKTX, up 11.5%. Didn't see anything company specific there. Oil rally helps out names like Diamondback, FANG, and Devon Energy, DVN. FANG up 8 3/4, Devon up 7.5%. Yes, on Friday, and Carnival Cruise Lines rally 6.5% after completing a capital raise late last week, but the trend there is still very much, I guess we can only describe it as ugly. On the loser side of the board, PAYC, nothing company specific. That stock down nearly 9%. Xerox calling off their bid for Hewlett Packard. Last week, that news came out around midweek. Stock was down 8.5% on Friday. MGM, obviously a coronavirus play to the downside, down 8%. Also, late last week, announced an executive departure. Didn't see anything company specific on Discover, DFS. That stock down nearly 8% on the day. And Win down nearly 8% as well. Now, I didn't see anything company specific on Win. Back on April 1st, we did get some Macau gaming data. Maybe investors are parsing through that, but Win obviously still very much part of that travel, lodging, and leisure group that has been under pressure, but also has been very volatile in both directions. So taking a look now at what we're talking about, we talked about the equity market with the S&P 500. Now we're looking at yields. As the 10-year yield is still consolidating. I mean, this is a wide consolidation, but it is a consolidation after a strong move to the downside that produced a deeply oversold condition for the RSI. We did get an interim rally that established the lower bound of a resistance zone, but notice that on that rally, the RSI barely got above 50, and now we've headed lower once again. And yields, and RSI is moving lower as well. I do expect this to be choppy, right, as investors square up positions. But I'm not convinced, as I've said, I'm not convinced that we've seen the low here in yields. Kind of interesting to me as well that as we saw a rally in treasuries last week that sent yields lower, still the utilities were under pressure. So maybe equity investors are starting to square up their positions a little bit. Maybe coming off some of the deeply defensive posture that we've seen. But as I said, we're going to continue to watch the utilities as a sign of investor sentiment in the marketplace, right? Whether they are offensive or not necessarily offensive, but maybe just less defensive in the near term. And obviously rates will be a big part of that relationship, especially as we look at the utilities on a relative basis. But the 10-year yield is consolidating here. I still expect, we've seen volatilities increase, not just in the equities, right? Gold volatility has increased. Treasury volatility has increased, right? We're seeing a lot of volatility across the board. I do expect that to remain the case this week as investors continue to square up their data. But take a look at treasuries here. I'm still not convinced that we've seen the lows, but I do expect it to be choppy. Now, we did see a rebound in crude oil last week, right? Some rumors of a potential production cut centering around Russia, Saudi Arabia, and the U.S. Over the weekend, however, it looked like that meeting was going to be pushed out to later this week. So despite the rally in crude last week, a couple of things that I'll say here. Number one, it's still very much in a downtrend below the declining 50 and 200-day moving averages, as well as being well below key resistance levels from this gap that opened up a few weeks ago. RSI remains solidly in bearish ranges. Notice how we easily become oversold, and on rallies, really don't get back above the 50 level. Chaikin money flow for crude, very much bearish. So the fact that it looks like the meeting is being pushed out to later this week actually has crude oil futures under pressure here this morning. We touched on that a little bit earlier. So we have seen a rebound in crude. We saw a rebound, right? Remember, the energy stocks are at the top of that list over the last 5 days. But I do think for now, the bulls are guilty until proven innocent. The trend still remains very much to the downside as far as I am concerned as it relates to crude oil and also as it relates to the energy complex. And kind of within that, we're seeing a rebound in the dollar. Taking a look at the Invesco DB US Dollar Index Fund, right? Big rally into the teeth of the sell-off in equities. And then we saw a pullback to the 50-day moving average in the support zone, and we've now started to rally once again. Now, notice that on the pullback, RSI doesn't get below 50. That's a sign that there's still some upside momentum to this move. And to the extent that the dollar continues to move higher, I think it's hard to get excited about commodities, right? Notice that as the dollar has rallied here, commodities sell off. Now, they both rallied a little bit last week. That's largely a function of crude being a big weight in the commodity complex, but now crude is back under pressure. The dollar is rallying, and if the dollar were to continue to rally, I have to think you'd start to see commodities come under pressure once again. So that's going to wrap us up for today. Head over to chaikinanalytics.com/test drive to sign up for that free 14-day trial, and I will be back here with you tomorrow morning. Have a great Monday.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.